wouldn't surprise me to see the price of gold up threefold or fourfold. That the immediate impact of higher energy prices would be reduced economic activity. And I think in the very near term, that would be bad for gold. There's a lot of people who think that gold rises on fear. In my life, gold has risen on a specific type of fear, which is to say lack of confidence in fiat-denominated monetary instruments. Gold does well during times of inflation, bad during times of deflation. And the longer-term impact of government policy in response to an economic slowdown would take gold higher. Daryl, as you know, I'm of the view that irrespective of the Straits of Hormuz, that government policy around the world, but particularly U.S. government policy, will lead to a decade-long decline in the purchasing power of most fiat currencies. I'm not suggesting, by the way, Daryl, I maintain U.S. dollar liquidity. I'm not suggesting that people save only in gold.
The Chinese are already, and the Russians are already less interested in holding dollars. With the Indians, Japanese are thinking twice. The Europeans, who hold a large amount of dollar-denominated assets.
What does that mean for gold? So where's gold headed? Like if you're looking... So Rick, you mentioned like having like a 5 to 10 year outlook and such, especially on, gold and some of these other commodities and such. So let's start with you, Rick. Where do you think gold could be, with all of these dynamics and all this money print?
I look at the decade of the 1970s as prologue. I think that was the last period where you had sustained and dramatic declines in the purchasing power of the U.S. dollar. And I think we were lulled by the period 1982 to 2022 into forgetting the lessons of the decade of the 70s. In the decade of the 70s, according to the government, the U.S. dollar lost 75% of its purchasing power. Not coincidentally, I think, the gold price increased 26-fold. I'm not suggesting, by the way, that gold is, don't get your listeners' hopes too high, Daryl. I'm not suggesting that the gold price is going to increase 26-fold. But I suspect that gold will maintain its purchasing power. If that happens, one could expect the price of gold to mirror the decline in the purchasing power of the U.S. dollar. A doubling of the gold price, the nominal gold price, over the next 10 years would be, from my point of view, a conservative estimate.
Gold is being treated as a slow hedge, yet the underlying math points to a major repricing cycle already forming. As Rick Rule points out here, the 1970s saw the US dollar lose about 75% of purchasing power, while gold rose roughly 26x, a pattern markets forgot after decades of stability. Slightly higher nominal targets assume stable erosion, but faster devaluation would rapidly reprice gold in real terms. Next, Rick Rule exposes why liquidity shocks break the 1970s analogy and reshape gold's trajectory entirely.
If I'm right, if gold maintains its purchasing power over 10 years in the face of a decline in the purchasing power of the currency that the gold price is measured in, it wouldn't surprise me to see the price of gold up threefold or fourfold, which is to say that gold would purchase approximately the same basket of goods and services 10 years from now that it purchases today, while the U.S. dollar would purchase substantially less by way of goods and services than it does today. I realize it's not an accurate number that you're looking for, Daryl. I'm not good for headlines, but I suspect that savers should anticipate that gold will, as it's done for millennia, preserve your purchasing power. Daryl, as you know, I began denominating a substantial part of my savings in gold in the year 2000. And when you look at price levels from that metric, gold has increased in price about 9% compounded since the year 2000. When you do that, real estate is cheap and energy is cheap. Groceries are cheap. Health insurance is cheap. When you measure the price of goods and services in the normal denominator, which is to say the U.S. dollar, all of those things are expensive. I think the lessons of the period 2000 to 2026 will become more manifest in the period 2025 to 2035.
Cash savings are quietly being re-rated against gold. Yet most portfolios still assume currency stability that no longer exists. As Rick Rule points out here, gold has compounded about 9% annually since 2000 when measured against fiat, quietly preserving purchasing power while real assets appear distorted. This framing implies real estate, energy, and healthcare only look expensive in dollar terms, masking long-term monetary erosion beneath surface price inflation. Next, Rick Rule reveals how long-term gold holders inadvertently expose the gap between nominal wealth and real purchasing power.
And I'm not suggesting, by the way, Daryl, I maintain U.S. dollar liquidity. I'm not suggesting that people save only in gold. I'm just suggesting that people consider allocating enough of their savings into gold so that the experience that I've enjoyed in the last 25 years extends to them over the next 10 years.
Okay. Dr. Thornton, what are your thoughts?
Well, I concur. I mean, when I look back from 99 to 24, what we did see is that gold was able to match or slightly exceed the emissions in the money supply, so that gold did as well as what the Fed was doing to bring down the economy. So it offset all of that, and it actually did better than stocks, which were relatively robust over that same 25-year period. I'm not sure that we're going to get a repeat of that going forward for the next 10 or maybe even 25 years, although it's hard to look past, the next 10 years out is difficult enough. But I suspect that not only is the U.S. and other central banks going to increase the amount of new money that they're injecting in the economy, but that money holders, individuals, companies, other nations, and so forth, are going to be less interested in holding U.S. dollars the way they were in the past.
Central banks are quietly testing assumptions about dollar demand, while most investors still believe liquidity conditions are stable. As Rick Rule points out here, gold has already matched or slightly exceeded money supply growth over decades, signaling it functions less as a trade asset and more as a parallel monetary system. That means future central bank liquidity expansion, combined with declining foreign demand for US assets, creates structural tailwinds for gold rather than temporary cyclical support. Next, Rick Rule exposes why global dollar diversification is accelerating faster than policymakers publicly acknowledged.
This is a point that Mises makes, and he says that decrease in the demand to hold money, or the dollars in this case, is really a prelude to a hyperinflationary environment, because if they're increasing the supply and people are decreasing their demand, it means that purchasing power of gold in this case is going to go up faster than the rate of monetary emissions. So the returns on gold may go off trend, may go above trend over the next 10 years, and particularly in the sense that, foreign holders of U.S. dollars in the Middle East, I suspect, are going to be less interested in holding dollars. The Chinese are already, and the Russians are already less interested in holding dollars. The same with the Indians, and I think the Japanese are thinking twice. And the Europeans, who hold a large amount of dollar-denominated assets in the U.S. economy, are probably also thinking. And, of course, there's the illegal markets in drugs and so forth, where they hold a lot of U.S. cash. I think a lot of those people, especially once the dollar hits a devaluation skid, or maybe the next time it does, that you're going to see this, people rethinking their general balancing of dollar holdings moving forward. And that's when gold will actually experience a higher rate of return, because we measure gold in terms of dollars.
Okay. Yes. Thank you for sharing that.
If global dollar demand fractures further, gold stops reacting to inflation and starts pricing systemic trust collapse. As Rick Rule points out here, when money supply rises while demand to hold currency falls, gold's purchasing power accelerates beyond nominal monetary expansion, creating outsized returns. That dynamic is already visible in countries reducing dollar reserves, signaling that gold is increasingly priced as the global hedge against currency instability. Next, Rick Rule exposes why the final trigger for gold's acceleration is not inflation itself, but collapsing confidence in dollar settlement systems.
Couple of things. One thing is I want to hear your perspective on how you're viewing gold in this particular dynamic, and then also there's been a lot of talk from many different investors on raising cash, and I believe you've mentioned raising cash as well. And so just curious in your thoughts there.
Anybody's guess, but I suspect that the immediate impact of higher energy prices would be reduced economic activity. And I think in the very near term, that would be bad for gold. There's a lot of people who think that gold rises on fear. In my life, gold has risen on a specific type of fear, which is to say lack of confidence in fiat-denominated monetary instruments. Gold does well during times of inflation, bad during times of deflation. Think of higher oil prices as a free market tax. And cash taken out of the broad economy, irrespective of who receives it, in the form of higher oil prices, I suspect would be bad for the economy in the near term. The ultimate consequence of that, if the last 50 years of government policy is any indication, would be artificially low interest rates and quantitative easing, which is to say the product of this economic decline would be the very types of policy that are extraordinarily good for gold. So one can guess that if the strait stays closed, that the near-term impact on precious metals prices would be lower.
Oil spikes are being framed as inflationary fuel for gold, yet liquidity stress is already tightening beneath the surface. As Rick Rule points out here, gold doesn't react to fear broadly, but to collapsing confidence in fiat systems, not short-term price shocks. The contradiction is that energy-driven slowdowns often trigger forced liquidity selling before any safe haven bid appears. For holders of metals or miners, that means short-term drawdowns can mask the exact conditions that precede major reaccumulation phases. Next, Rick Rule reveals how policy intervention after the slowdown becomes the real catalyst no one is pricing in.
And the longer-term impact of government policy in response to an economic slowdown would take gold higher. Daryl, as you know, I'm of the view that irrespective of the Straits of Hormuz, that government policy around the world, but particularly U.S. government policy, will lead to a decade-long decline in the purchasing power of most fiat currencies, a decline in purchasing power that's greater than the nominal interest rate paid by bonds in those currencies. So I'm a 10-year gold bull anyway. Think of this as a fairly ugly speed bump.
Okay. Thank you for sharing that. And Mark, what's your take on this? Does this impact your thesis at all, or does it reinforce it? Just curious in your thoughts.
Well, as bad as war is, and Mises said it was unequivocally bad for the economy and our standard of living, I typically don't put much weight on regional conflicts. However, in this case, of course, the region that's at war is very critical to the overall global economy and the division of labor that exists and has been amplified because of, a long period of globalism where we're all interrelated to such a high degree. And the average American or the average citizen around the world, they look at the situation and they just say, oil prices, gasoline prices, directly into my budget.
Bond markets are still pricing stability, while long-term purchasing power trends are quietly breaking. As Rick Rule points out here, fiat currencies are heading into a decade-long erosion phase, where bond yields fail to compensate for real depreciation. That disconnect forces capital toward assets that preserve value rather than generate yield, reshaping allocation behavior beneath headline stability. For investors, this means traditional fixed income stops functioning as safe, shifting risk into duration itself. Next, Rick Rule exposes why geopolitical shocks matter less than the policy response they force.
But the Middle East is really critical for a variety of basic inputs, oil and natural gas. But because of that, there's derivatives and byproducts that have also gone unproduced, and facilities that have been destroyed, or the oil fields have been shut down, and it takes a long time for that to open up. The facilities, a long time to be rebuilt, and all of the things that we're learning about, such as sulfuric acid and helium, aluminum, that come out or are helped, promoted in the structure of production of our final goods and services, all of these things are going to have ramifications into mining and the production of plastics and the packaging and transportation of things around the global economy. And it's going to get much worse. Every day that the Straits of Hormuz stays closed makes these problems even worse as we go on. And I think, to a large extent, we haven't really seen the full, as Rick said, we haven't really seen the full force of the shutdowns and the blockages reaching our structure of production in other countries around the world because of inventories. And so because of the destruction and the shutdown of production in the Middle East and our ability to use up existing inventories, the problem get much, much worse. In terms of my investment thesis, which is for a commodity supercycle,
supply chain stress is no longer isolated to energy. It is cascading into industrial inputs most investors never price in. As Rick Rule points out here, disruptions in oil and gas feed directly into sulfuric acid, helium, and aluminum supply chains, amplifying cost pressure across global production systems. The contradiction is that inventories are masking real-time shortages, delaying visible price impacts while underlying scarcity builds. For commodity and mining investors, this is early-stage positioning before pricing fully reflects structural disruption. Next, Rick Rule exposes how inventory buffers are temporarily hiding the scale of the supply shock.
I think that it's sort of kick-started that whole thing, and it may be, a big leg up in commodity prices, which then sees a drawdown when the war is over and the straits are opened up eventually. But my general thesis is for commodity supercycle of upward and higher prices. And to get to your question about gold, I think that this all sorts of fits together because gold leads the commodity supercycle. And what we've seen in 2026 is that gold peaked out on a short-term basis and then declined. But then other commodity prices, relative prices, have risen. And then, of course, because of the war, they've risen even faster. Oil, aluminum, helium, a lot of other things. And so, if you look at the gold price, it's declined since the end of January. But if you look at the CRB index of commodity prices, well, that's been zooming higher. So our basic thesis about the commodity supercycle, I think, is very much intact.
Gold is weakening while broader commodities accelerate, signaling rotation rather than collapse. As Rick Rule points out here, Gold often leads commodity cycles, and its recent pullback against a rising CRB index suggests early-stage capital reallocation rather than trend failure. The key question is whether institutions are accumulating during weakness or waiting for confirmation, which determines the next phase of the supercycle. For investors, this divergence often precedes the strongest phase of mining outperformance.